Before we jump in, yes, you guys called out the new face and you were absolutely right. Using the same avatar as every other channel wasn't helping my credibility, so I switched to something that actually resembles the real me. There's a real analyst behind this, and there always has been. Hopefully, this makes that clearer. Welcome back to Metals and Market. Let's go. The moment everything changed, it's midday here on the East Coast as I'm recording this, and I need to tell you what just happened. As I was saying, I've been a private commodities analyst and physical silver stacker for 12 years now, and I've never seen anything quite like this. About 3 hours ago, I was looking at the silver bid price, and it hit $94.53. That's a 41% vertical climb in a single month. Now, the financial media is already spinning this. They're calling it a speculative frenzy, market PTSD from the 2011 crash, all the usual narratives designed to make you doubt what you're seeing. They're telling you to wait for the pullback. They're pointing at the fact that silver mining stocks have only moved 16%, while the metal itself is up 41%. And they're using that 25% lag as proof that this rally is fake, that it's built on sand, and that you should sit on your hands. But here's what they're missing. They're looking through a rear-view mirror at a landscape that no longer exists. The real story isn't the price on your screen. The real story is what's happening on the ground, in the vaults, at the dealers in Shanghai. The real story is that physical silver is becoming what I can only describe as unobtainium. Stop looking at the ticker for a second. Look at the empty vaults, because the disconnect between the metal and the companies that pull it from the earth has reached a violent breaking point, and the catalyst for the explosion isn't what you think. The Hoover Dam moment. Let me be very clear about what we're witnessing right now. Physical silver has surged 41% to $94.53. The silver miners tracked by the SEL ETF have only moved 16%. That's a 25% lag, and it represents the most coiled spring I've seen in over a decade of analyzing this sector. Here's the context that makes this absolutely insane. The entire global silver mining sector is valued at roughly $300 billion. $300 billion. It's smaller than Netflix, which sits at $400 billion. It's smaller than Home Depot at $380 billion. We're talking about the entire sector that produces one of the most critical industrial metals on the planet, and it's valued less than a single home. The entire sector that produces one of the most critical industrial metals on the planet is valued at roughly $300 billion. That's smaller than Netflix, which sits at $400 billion, and smaller than Home Depot at $380 billion. We're talking about a sector valued less than a single home improvement retailer. In this video, I'm going to walk you through the operating leverage mechanism that Wall Street is either ignoring or hasn't figured out yet. I'll run the actual math on the earnings tsunami that's about to hit and share my personal 3-tiered battle plan for how I'm positioning through the 3 phases of this re-rating. Here's the thing that keeps me up at night. If even half of 1% of institutional capital tries to enter this tiny sector, it's like trying to fit the contents of the Hoover Dam through a garden hose. The physics don't work and something has to give. Why miners multiply the metal? Let's pull this apart, because this is the foundation of everything that's about to happen. Operating leverage is the mathematical reason why mining stocks outperform the underlying metal. It's not speculation, it's not hope, it's just math. But most people don't understand the mechanism, so they miss the move entirely. Here's the definition. A mining company's all-in sustaining costs, what we call AISC, are relatively fixed. We're talking about diesel fuel, labor costs, and the cost of running the machines that pull metal out of the ground. These costs don't change much whether silver is at $50 or $90. So every single dollar that the silver price rises above that fixed cost becomes pure. It's exponential profit. Think of it like this. Imagine I own a lemonade stand and it costs me 50 cents to make a cup of lemonade. If I sell it for $1, I make 50 cents in profit. Pretty simple. But now, let's say the price of lemonade suddenly jumps to $2. My cost is still 50 cents, but my profit just tripled from 50 cents to $1.50. That's a 100% increase in price, creating a 200% increase in profit. That's operating leverage. Now, here's where it gets interesting in the context of what's happening right now. Wall Street's models are still stuck in what I call scenario A. They're pricing these mining companies as if silver is at $55, maybe $60, if you're looking at the most optimistic analyst reports. But silver isn't at $55, it's at $94. Let me show you the math, because this is where the disconnect becomes almost offensive. If we assume an average all-in sustaining cost of $20 per ounce, which is fairly standard for primary, if you're looking at the most optimistic analyst reports, silver isn't at $55, it's at $94. Let me show you the math, because this is where the disconnect becomes almost offensive. If we assume an average all-in sustaining cost of $20 per ounce, which is fairly standard for primary silver producers, here's what the profit looks like. At $55 silver, the profit per ounce is $35. At $93 silver, which is where we are right now, the profit per ounce is $73. That's a 69% increase in the price of silver, creating a 108.5% increase in profit per ounce. 108.5%. And the market is pricing these companies as if silver is still at $55. The earnings reports haven't caught up yet because we're between quarters. The analysts haven't updated their models because they don't believe this price is sustainable. But the reality of $94 silver is about to hit the quarterly reports like a freight train. Let me tell you what I was seeing earlier today, because the price is only half the story. As of late this morning, silver was bid at $94.53. Gold was at $4,675.42. But here's the thing that's not making headlines. The Shanghai physical market, the Shanghai, is trading silver at over $103 per ounce. That's a $9 premium over the Western paper markets. In the world of physical commodities, a $9 premium is not noise. It's a gravitational force. It's a magnet that is draining Western vaults in real time to capture that arbitrage profit. When you can buy silver in New York or London at $94 and immediately sell it in Shanghai for $103, you do that trade all day long until the inventory runs out, which is exactly what's happening. Now, let's talk about the retail side, because this is where it gets truly wild. COMEX, which is the world's largest online precious metals dealer, just instituted a $500 minimum for silver orders. $500. And they've publicly admitted that their output is going to be cut by 50% due to supply chain breaks. Let that sink in for a second. You can't buy 4 coins anymore. The system is seizing up. I've been stacking physical silver for 12 years, and I've never seen order minimums like this outside of the absolute peak panic moments. This isn't business as usual. This is triage. And here's why this matters for the mining stocks. When the physical metal becomes unobtainium, when you can't walk into a dealer and buy it, when online inventories are depleted, the only liquid way for a pension fund or an institution to get silver exposure is to buy the miners. They can't buy 50 million ounces of. When the physical metal becomes unobtainable, when you can't walk into a dealer and buy it, and when online inventories are depleted, the only liquid way for a pension fund or an institution to gain silver exposure is to buy the miners. They cannot purchase 50 million ounces of physical silver that does not exist, but they can buy $10 million worth of Heckler or First Majestic in an afternoon. The exit door is getting smaller, and the crowd hasn't figured it out yet. Now, I want to address the counter-argument head-on, because there are smart people who believe this is all going to collapse. The skeptics argue that a deflationary shock or a broader market crash will force investors to sell miners to cover losses elsewhere. I am not dismissive of that risk. We've witnessed forced liquidation events before, in 2008 and 2020. Margin calls come quickly and without discrimination. However, here's what the skeptics are overlooking: the structural deficit. In 2025, the silver market experienced a deficit of 150 million ounces, marking the 5th consecutive year of shortfall. You cannot print more silver to rectify a 15-year lack of exploration spending. The notion that high prices solve high prices by increasing supply is a comforting myth that applies to widgets and software licenses, but it does not work for mining. It takes 10 to 15 years to bring a discovery into production, requiring exploration, permitting, financing, and construction. There is no switch to flip. Even if silver reached $200 tomorrow and every CEO in the sector began green-lighting projects, meaningful new supply would not be seen until the late 2030s. The smart money is waiting for a pullback that the structural deficit simply will not permit. They are anticipating silver to crash back to $60 so they can buy the miners on sale. But what if $60 never materializes? What if the physical shortage creates a new floor? That is the scenario that nobody is pricing in, and it is the scenario that is currently unfolding. They are not running the numbers. Let me walk you through the figures that Wall Street is refusing to acknowledge. Here is a side-by-side comparison of what the models predict versus what reality is delivering. In scenario A, which represents the consensus Wall Street view, silver is at $55. The all-in sustaining cost is $20, resulting in a profit of $35 per ounce. In scenario B, which reflects the current spot price, silver is at $93. The all-in sustaining cost remains $20 because it is fixed, leading to a profit of $73 per ounce. This represents a 69% increase in price, yielding a 108.5% increase in profit. Now, let's stress test this. Let's say I am wrong. B, which is literally the current spot price, silver is at $93. The all-in sustaining cost is still $20 because it's fixed. The profit per ounce is $73. That's a 69% increase in the price, creating a 108.5% increase in profit. Now, let's stress test this. Let's say I'm wrong. Let's say silver pulls back 20% from here. That would take us down to around $75. At $75 with a $20 AIC, the profit per ounce is $55. That's still a 57% increase over the $35 profit at $55 silver. Even in the pessimistic scenario, miners are already priced for levels that are massively below current reality. Now, let's talk about the gap that's developed between the metal and the stocks. Physical silver is up 41% this month. The SIL ETF, which tracks the major silver miners, is only up 16%. This is a historic anomaly, and I don't use that phrase lightly. When you see the metal run this hard and the miners lag this severely, one of two things is happening. Either the market is calling the metal price fake and pricing in an imminent collapse, or the market is slow to recognize the profit implications, and we're about to see a violent catch-up. Given the structural deficit, given the $9 Shanghai premium, and given the retail scarcity we're seeing at dealers, I'm betting on the catch-up. Let me recap where we are, because this is the foundation of the entire CIS. We have a structural deficit that's been building for 5 years. We have a $9 premium in Shanghai that's draining Western vaults. We have retail scarcity that's forcing dealers to institute $500 minimums. And we have mining company profits that are doubling in real time while the stock prices haven't moved. The math says miners should be doubling their market caps, but they haven't moved yet. And here's the kicker. When the quarterly earnings reports drop in the next few weeks and show 100% profit growth, this 25% lag is going to disappear in a single afternoon. The market will reprick these companies faster than most people can react. Let's talk about what happens next. Because the real move hasn't even started yet. Pensions and endowments are starting to realize that silver is a hedge against persistent inflation. Not transitory inflation, not the kind that the Fed can squash with 2 rate hikes, but the structural embedded inflation that comes from decades of currency debasement. And here's where the math gets truly absurd. A single 100 billion pension fund moving just half of 1% of its assets into silver would require $500 million in silver exposure. $500 million is roughly 10% of the entire SIL ETFs. This is embedded inflation that comes from decades of currency debasement. And here's where the math gets truly absurd. A single 100 billion pension fund moving just half of 1% of its assets into silver would require $500 million in silver exposure. $500 million is rough. The 10% of the entire SIL ETF's market cap. Think about that. One pension fund making one modest allocation decision could move 10% of the entire sector. Now imagine 10 pension funds doing the same thing. Imagine sovereign wealth funds getting involved. Imagine family offices that currently hold zero commodities exposure deciding they need 3 to 5%. The supply side of this equation is fixed. You can't create more Heckles than exists. You can't manufacture more First Majestic stock. And you definitely can't produce more physical silver in the time frame that demand is accelerating. So, I'm watching 3 specific indicators right now to tell me where we are in this cycle. First, the Shanghai premium convergence. If New York starts chasing Shanghai toward $13, that tells me the Western paper market is finally acknowledging the physical reality. Right now, there's still a $9 gap. which means the paper market is in denial. When that gap closes, it's game over. Second, COMEX logistics. If those $500 order minimums rise further, or if their inventory goes to zero, that tells me we've crossed from scarcity into full panic. We're not there yet, but we're close. Heard the earnings tsunami. The upcoming One Guatemalan Quetzal 2026 reports are going to show profits that Wall Street isn't expecting. When those numbers hit, the analysts are going to scramble to update their models, and the sector is going to rip in hours, not weeks. We are moving from a speculative market to a physical survival market, and the exit door is getting smaller every day. Let me be very clear. This is not advice. This is what I am doing with my own capital based on 12 years of watching this sector. I believe we're in the Hoover Dam moment where fundamental demand and massive profit margins are about to collide with a tiny overlooked sector that the market has ignored for over a decade. So, here's my conditional plan, and I'm breaking it into 3 phases based on what the data tells me. Phase 1, if silver sustains above $93, which it's doing right now, I'm personally focusing on the primary producers. I'm talking about companies like Hecla, ticker HL, and First Majestic, ticker AEG. These are the companies with immediate cash flow talk. They're pulling metal out of the ground today. They're selling it at $94 and their costs are fixed at $20. The profit explosion is instantaneous. This is not, I'm talking about companies like Hecla, ticker HL, and First Majestic, ticker AEG. These are the companies with immediate cash flow talk. They're pulling metal out of the ground today. They're selling it at $94 and their costs are fixed at $20. The profit explosion is instantaneous. This is not a speculation on future production. It's a bet on math that's happening in real time. Phase 2, if the Shanghai premium stays above $10, I view that as a gravitational floor that prevents a crash back to $50 or $60 silver. That's the level where I start moving further out the risk curve into developers. Companies like Discovery Silver, ticker DSVSF, that have massive deposits but aren't in full production yet. These are higher risk, but if the metal stays elevated, they're the next layer of the re-rating, phase 3. If institutional volume spikes in the CL ETF, if I start seeing 10 or 20 million share days instead of the usual 2 to 3 million, that tells me the big money is entering. At that point, I would personally look to rotate some profits into the explorers and the royalty companies because that's when the entire food chain gets repriced. But right now, we're in phase 1. And I am not viewing this 25% lag as a warning. I am viewing it as a once-in-a-generation entry point. The market is offering you the chance to buy companies that are doubling their profits at valuations that assume silver is still at $55. That doesn't happen often, and when it doesn't last long. Addressing the obvious now, I know what some of you are thinking. You're thinking, if this is so obvious, why isn't everyone doing it? And the answer is simple. Because it requires you to ignore the financial media, ignore the consensus, and trust math over narrative. Most people can't do that. They need CNBC to tell them it's okay to buy. They need Goldman Sachs to upgrade the sector before they'll touch it. By the time that happens, the move is over. I've been doing this for 12 years and I can tell you with absolute certainty, the biggest gains come when you're early, when it feels affordable. When your friends think you're crazy for buying mining stocks instead of the latest AI hype. The crowd is always late. The crowd is always wrong. And the crowd is currently sitting on the sidelines waiting for permission that will never come. So, yeah, enjoy being early. It's lonely, but it pays better. I want to address something that I've heard over and over again from people who lived through 2011. They say, we've seen wrong. And the crowd is currently sitting on the sidelines waiting for permission that will never come. So, yeah, enjoy being early. It's lonely, but it pays better. I want to address something that I've heard over and over again from people who lived through 2011. They say, we've seen this before. Silver ran to $48, then it crashed back to $14 and stayed there for a decade. This is just another pump and dump. And I get it. That scar tissue is real. A lot of people got destroyed in that collapse. But this time is structurally different, and I'm going to tell you why. In 2011, the rally was driven almost entirely by investment demand. Retail speculators and ETF flows pushed the price up, but there was no underlying supply deficit. When the momentum broke, the price collapsed because there was no floor. Today, we have a 5-year structural deficit of 150 million ounces per year. We have industrial demand from solar panels electric vehicles and electronics that is not going away. We have central banks and emerging markets buying precious metal. Taos to diversify away from the dollar. This is not a speculative bubble. This is a physical shortage meeting exponential demand growth. And here's the other difference. In 2011, the miners were priced ahead of the metal. They ran up faster than silver did. So when silver collapsed, the miners got obliterated because they were overvalued. Today, the miners are lagging the metal by 25%. They're undervalued relative to the current spot price, which means they have room to run even if silver consolidates here. So no, this is not 2011. The setup is inverted, the fundamentals are inverted, and the outcome is going to be inverted. There's a bigger picture here that I think most people are missing. We are living through a global monetary reset, whether the central banks want to admit it or not. The dollar is losing its grip as the world's reserve currency, not overnight, but incrementally in deals and agreements that don't make headlines. China and Russia are settling trade in yuan and rubles. Saudi Arabia is accepting yuan for oil. The BRICS nations are building alternative payment rails that bypass SWIFT entirely. And in that environment, hard assets matter. Gold and silver are the only forms of money that don't require trust in a government or a central bank. They can't be printed, they can't be debased, and they can't be frozen by executive order. So when I look at $94 silver, I don't just see a commodities trade. I see a vote of no confidence in the fiat system. I see people and institutions realizing that the emperor they can't be printed, debased, or frozen by executive order. So when I look at $94 silver, I don't just see a commodities trade. I see a vote of no confidence in the fiat system. I see people and institutions realizing that the emperor has no clothes and that the only way to preserve wealth is to own things that are real. Silver is real. Mining companies that pull it from the ground are real. And the profits they're generating at these prices are real. Everything else is just accounting entries on a screen, the invisible hand of arbitrage. Let me come back to the Shanghai premium for a second, because this is one of the most important dynamics in the market right now, and almost nobody is talking about it. When silver trades at $94 in New York and $13 in Shanghai, that $9 spread is not random. It's not a glitch. It's a price signal screaming that physical demand in the East is outstripping supply. Here's what happens in practice. Arbitrage traders buy silver in London or New York at $94, ship it to Shanghai and sell it for $13. They pocket the $9 spread minus shipping and insurance, which is maybe 50 cents. That's an $8.50 risk-free profit per ounce. So they do it again and again and again until the vaults in London and New York are empty. This is not a theoretical exercise. This is happening right now. The COMEX inventories are draining. The SLV ETF, which is the largest silver ETF in the world, is seeing outflows as bullion. Banks pull physical metal to meet arbitrage demand. And here's the thing. Once those vaults are empty, the paper market breaks, because the paper market only works if there's physical metal backing it. When the metal is gone, the paper becomes worthless. We saw a glimpse of this in 2020 when the futures market went into backwardation and some contracts were settled in cash instead of metal because the physical wasn't available. If that happens again, but on a larger scale, the price of silver won't just go up, it will gap up. We're talking about $10, $15, $20 moves in a single session because there's no inventory to absorb the demand. And when that happens, the miners won't lag, they'll lead. Let me paint a picture of what's about to happen when the first quarter earnings reports start dropping. Right now, the analysts covering these companies have price targets based on $55 to $60 silver. Their models assume modest production growth, flat costs, and incremental margin expansion. But the reality is that these companies just spent. Here's the formatted transcript section. This is a picture of what about to happen when the first quarter earnings reports start dropping. Right now, the analysts covering these companies have price targets based on $55 to $60 silver. Their models assume modest production growth, flat costs, and incremental margin expansion. But the reality is that these companies just spent an entire quarter selling silver at $90 plus dollars while their cost stayed at $20. So Heckler reports earnings and shows that their profit per ounce doubled. The analysts are going to scramble. They're going to update their models, raise their price targets, and issue upgrades. And when one analyst does it, the others follow because nobody wants to be the guy who missed the move. That's when the institutional money comes in. Because institutions don't buy on speculation. They buy on upgrades, on earnings beats, on proof that the thesis is working. Right now, we're in the quiet period before the storm. The data is there, the profits are being generated, but the reports haven't been filed yet. When they are, this 25% lag is going to close faster than most people can process. And if you wait until after the reports to buy, you're going to be paying 30% to 40% more than you would today. I've been thinking a lot about why most people miss moves like this, even when the data is sitting right in front of them. And I think it comes down to conditioning. We've been conditioned to trust authority, to wait for permission, to follow the herd. We've been conditioned to believe that if something is a good investment, CNBC will tell us. If it's a good trade, Goldman Sachs will issue a buy rating. But the reality is that by the time the mainstream media picks up on a trend, the early move is already over. By the time the big banks issue their upgrades, the easy money has been made. The real alpha, the real asymmetric returns come from being early. And being early means being uncomfortable. It means buying when everyone else is skeptical. It means trusting your own analysis over the consensus. I'm not saying this to sound superior. I'm saying it because I've missed moves in the past by waiting for confirmation that never came. I've sat on the sidelines while stocks doubled because I wanted one more data point, one more analyst upgrade, one more sign that I was right. And by the time I got that confirmation, the opportunity was gone. So, if you're waiting for the perfect moment, for the all-clear signal, for the mainstream media to validate this thesis, you're going to miss it. The perfect moment was 3 weeks ago when that I was right. And by the time I got that confirmation, the opportunity was gone. So if you're waiting for the perfect moment, for the all-clear signal, for the mainstream media to validate this thesis, you're going to miss it. The perfect moment was 3 weeks ago when silver was at $65 and the miners hadn't moved yet. The second best moment is right now. Let me walk you through the 3 phases of the re-rating and how I think this plays out over the next 6 to 12 months. Because I don't think this is a linear move. I think it happens in phases, and each phase requires a different strategy. Phase 1 is what we're in right now. This is the stealth accumulation phase, where physical silver is running, the miners are lagging, and the smart money is quietly building positions before the earnings reports drop. The S phase ends when the first quarter earnings hit and the analysts start upgrading their models. Phase 2 is the institutional recognition phase. This is when the big pension funds and endowments start allocating capital to the sector. You'll see it in the volume. Instead of 2 million shares a day in the SILE ETF, you'll see 10 or 15 million. This is when the primary producers double or triple from current levels. Phase 3 is the mania phase. This is when retail investors pile in, when your barber is asking you about silver stocks, when CNBC is running specials on the mining sector. This is also when you start taking profits, because the mania phase never lasts. Right now, we're in phase 1. And the opportunity in phase 1 is to position in the highest quality producers at valuations that won't exist once we hit phase 2. I want to be balanced here because every thesis has risks, and I'm not going to pretend this is a sure thing. The biggest risk I see is a deflationary shock. If we get a 2008 style credit crisis, if the stock market crashes, if we see forced liquidation across all asset classes, then yes, the miners will get sold along with everything else. But here's the thing, even in that scenario, I don't think silver goes back to $50 because the structural deficit doesn't go away, the industrial demand doesn't go away, and the central banks that are buying gold and silver as a hedge against fiat collapse don't suddenly stop buying. So, worst case, we get a short dip that gets bought aggressively because the physical shortage creates a floor. The other risk is that I'm wrong about the timeline. Maybe the earnings reports don't catalyze the move. Maybe it takes 6, a hedge against fiat collapse, don't suddenly stop buying. So in the worst case scenario, we get a short-term dip that gets bought aggressively because the physical shortage creates a floor. The other risk is that I'm wrong about the timeline. Maybe the earnings reports don't catalyze the move. Maybe it takes 6 months instead of 6 weeks for the market to reprice these companies. But even if the timing is off, the math doesn't change. These companies are generating 108% profit growth at current silver prices. That's not a projection, that's a fact. And eventually the market price is in fact. So yes, there's risk. There's always risk. But the risk reward here is as asymmetric as anything I've seen in 12 years of doing this. Here's something I've been paying attention to that doesn't get talked about much: insider buying. When the executives and board members of these mining companies are buying shares with their own money, that tells you something. These are the people who see the balance sheets, who know the production numbers, who understand the profit margins better than anyone. And over the last few weeks, I've seen a cluster of insider buys at several of the primary producers. Now, insider buying doesn't guarantee anything. Sometimes insiders are wrong. Sometimes babies, they buy at the top. But when you see multiple insiders at multiple companies all buying within the same window while the stock prices are lagging the metal, that's a signal worth paying attention to. They're not buying because they think silver is going back to $50. They're buying because they know what the earnings are going to look like, and they know the market is mispricing their companies. Let me bring this back to the title of this video, the Unobtainium phase. Unobtainium is a term from the movie Avatar. It's a fictional metal that's incredibly valuable and incredibly scarce. And while silver isn't fictional, the scarcity we're seeing right now is starting to mirror that dynamic.